Hello, fellow risk takers, and welcome to my worst investment ever. Stories of loss to keep you winning. In our community, we know that to win in investing, you must take risk, but to win big, you've got to reduce it. To join our community, go to myworstinvestmentever.com and receive these 5 free benefits. First, you get the risk reduction checklist I've created from the lessons I've learned from all my guests. Second, you get my weekly email to help you increase your investment return. Third, you get a 25% discount on all A-Stotz Academy courses. Fourth, you get access to our Facebook community to get to know guests and fellow listeners. And finally, you get my curated list of the top 10 podcast episodes. Fellow risk takers, this is your worst podcast host, Andrew Stotz from A-Stotz Academy, and I'm here with featured guest Kevin Carter. Kevin, are you ready to rock?
I'm ready.
Well, let me introduce you to the audience. Kevin Carter is the founder and CIO of the Emerging Markets Internet and E-Commerce ETF, which is under the ticker code EMQQ on the New York Stock Exchange, and he's chairman of the EMQQ Index Committee. Prior to EMQQ, Kevin was the founder and CEO of Alpha Shares, an investment firm offering 5 emerging markets ETFs in partnership with Guggenheim Investments. Previously, Kevin was the founder and CEO of Active Index Advisors, acquired by Natixis in 2005, and the founder and CEO of E-Investing, acquired by E-Trade in 2000. Kevin received a degree in economics from the University of Arizona and began his career in 1992 when he walked into the offices of Robertson, Stevenson and Company. Kevin, take a minute and fill in further tidbits about your life.
Well, I didn't get very far. I live 15 miles east of San Francisco, and I can see the hospital I was born in from my desk and from my bed. So I haven't gone very far, and I've worked in the investment business for 28 years. And I first and foremost, as an investor, I pray towards Omaha, and I try to think about all things through a Warren Buffett and Charlie Munger lens. But for the last 20 years, I've had one foot in the active world and one foot in the indexing world with my long time partner, Bert Malkiel.
It's interesting. I came to Thailand in 1992 and entered the world of finance in 1993. So just about the same amount of time, except I did all of that here in little old Thailand, as the Thai economy was busting, booming, busting, booming, and busting. But you did a lot of your investment in emerging markets, let's say, from all the way over in the U.S. I'm just curious, maybe you can just tell us a little about the evolution, particularly. I'm interested in EMQQ a little bit to hear about what it's doing, and for those people who are investing who would like to know about it, who are listening, maybe you can just give us a little briefing about that.
Sure. Well, when I got involved with emerging markets 16 years ago, I basically learned 2 things on the first day, which, I give a lot of presentations and I tell people there's only 2 things you need to know. And I learned both of them on the first day. And the first thing, the positive thing, is that, the thing that's emerging in emerging markets are the people, right? You've got billions of people, 85% of the world's people, and their economies are growing faster on average. Their incomes are going up, and they want stuff. They want more and better food, more and better clothing, appliances, entertainment, vacations, cars, and they want their kids to go to Harvard. And so that's lesson number 1 and the most important thing. And then lesson number 2 is a problem. And I learned this in the first 5 minutes when I got involved first with China. We had, as I talked to you as we were getting ready, I had some Google engineers that were clients of mine right after their IPO, and they said, "Hey, we want to invest in China." And I said, "Fine, I'll try to figure that out." And I figured we'd use an ETF, and I went over to our portfolio managers and I said, "Look, give me a list of all the companies in the China ETF, because these Google people want to invest in China." And before they gave me the list, my partner Bert pulled me aside and goes, "Look, when you get the list of all the companies in the China ETF, you're going to see that most of them are Chinese government-owned banks and oil companies." And I was sort of skeptical and said, "Yeah, I've heard about that." And he went on to explain how a Chinese bank might make a loan to a company that was basically bankrupt so they wouldn't lay off their employees and have protesters. And that really bothered me. And in the case of the China ETF back then, it was 80% state-owned enterprises and only 7 or 8% in the consumer. And so those are the two most important things. Is if you want to make money in emerging markets, you probably shouldn't buy the index, at least the big traditional index, because it's full of these inefficient and corrupt government-owned banks and oil companies, and the corruption is terrible. You got presidents of countries going to jail, as has happened in Brazil twice and Korea once. So you really got to focus on the consumer. And for a long time, I told people to just buy the emerging market consumer ETF. When they'd say, what's the best way to invest in emerging markets? I'd say easy. McKinsey says the growth of the consumer is the biggest growth opportunity in the history of capitalism. And there's a ticker symbol for that, ECON. And I had nothing to do with that ETF, but I knew it existed, and it owned the 30 largest consumer stocks. And about 8 years ago, I had looked at my own portfolio, which was very concentrated. I had 5 stocks, all of which were plays on the emerging market consumer. And 3 of those companies were in the emerging market consumer ETF, and the database called them consumer companies. They were Chinese snack food and clothing companies. But then I had 2 other companies that were definitely consumer plays, but they weren't in the emerging market consumer ETF because the database put them in a box called technology. And those 2 were the Craigslist of China, Wuba, which traded on the New York Stock Exchange, has gone private now. And the 5th company was Mercado Libre on the NASDAQ MELI, which is the Amazon.com of Brazil. And after I looked at my portfolio, I thought all of these are great plays on the consumer. The ones that are called consumer are growing at 15 or 20%, and I think they have a moat in form of brand equity. But the 2 other companies that are called technology companies, they were growing at 100% and had incredible margins. Wuba had a 94% gross margin, which is where I look for moats. And while the PEs were higher, the PE divided by the growth rate, the PEG ratio, which is all I care about, was lower and very reasonable. And so I had that thought, and then a few hours later, my phone rang, and it was a friend of mine with a 3-year-old daughter, and she said, what's the best emerging markets ETF for my daughter's college fund? And I started to tell her to buy the emerging market consumer ETF, and then I thought, wait a minute, that's not the best. The best one doesn't exist yet. It's the emerging market internet companies. And I literally went back to my office after I got that call and started to build EMQQ.
And what year was that?
It launched in November 2014.
So you've now been doing that for, let's say, nearly 8 years.
6.5. It will be 7 in November.
Okay, got it. And how many stocks are in that ETF, roughly?
Well, right now there's 96 companies, but the list is growing. When we launched, there was 40 something, and this is the fastest growing sector in the world, and there are literally hundreds of unicorns. Whether it's the Uber of Indonesia or the
Gojek.
Gojek, or there's lots going on. The Amazon of India, Flipkart, the Uber of China is coming public. So I think we'll be over 120 companies by the end of the year.
And from a let's say a region or a country weighting, is it mainly China or mainly Asia, or how is the weighting distribution?
Well, so we own every single publicly traded emerging markets internet or frontier market. Emerging market internet or e-commerce company, and we include frontier markets in our definition of emerging. It's about 2/3 China, a little less, 60-something% China. And in Asia is definitely, the largest part of it, as it should be. Asia's, if you look at emerging markets on a GDP basis or on a stock market cap basis or on a population basis, it's about 60% Asia to start with. So that's, it's the weighting in the internet space is a little bit bigger than in the broader indexes. And then it's about, in our fund, probably 10% to 15% South America,
Mm,
and then the rest Eastern Europe and Africa.
yep. And just out of, I mean, I'm very interested, and I know that some of the listeners would be interested in this type of exposure. Maybe you could just explain how is the stock selection process? Like when most people who are listening think of investing through some sort of ETF or fund, they think about an active fund manager picking the best bets, putting the money down and making those. But sometimes with an index or a passive ETF, generally the fund manager will just say, I own all of those stocks at market cap weighting. So you kind of got a very large, difference here between a passive fund and a pure active fund. How do you fit into that scheme of things as far as stock selection is concerned?
Sure. Well, I mean, ultimately, this is a rules-based index. So we don't use the P word, passive,
Yep.
here. I think that it's correct to consider most indexes passive, but as you know, and as I've said, I mean, I come from the active side, and that's one of the things that I think has given me an advantage in the indexing world is that I understand investing and I understand what gives companies value, and I ask questions. And what I've found is that um, for whatever reason, the people that populate the world of indexing don't always do that. And so I found a lot of problems in the passive version of indexing. So, for example, when you get into emerging markets, sometimes you have a country that the database says is in this country or that country, but then you open the financial statements and you find out all of the revenues coming from a totally different country. So you might have for example, there's a South African furniture company that was the largest holding in the emerging market consumer ETF. And the database said it was South Africa and it made furniture. So that was a consumer durable. And it was true, the company traded in Johannesburg and was headquartered in South Africa, but all of the stores that sold the furniture were in France and Germany and Australia. So the database doesn't always match the reality. So we have to do a decent amount of manual work in identifying the proper companies and making sure things don't get missed. And we've also recently added a rule to our index that gives the index committee the ability to basically override the rules. And if something is getting missed by the rules that should be included, or something's getting included that we don't think should be included, we can exclude it. So I'd say we're on the cutting edge, if you will, of the very gray area between traditional active and indexing.
And when let's just say that you go through your rules process, to me, it sounds like your rules process is kind of maybe somewhat of an elimination process, or is it a ranking process? In other words, once you've got your universe to say, okay, these 96 companies fit our rules, then what is the structure or the idea about how you then weight? Is it market cap weight, or is it some other type of weight?
It's market cap weighted, with one modification, which is the largest position is limited to 8%. So when we rebalance in June and December, we'll rebalance back to a market cap weighting with 8% as the largest weight. And that's because Alibaba and Tencent, which are the two largest of these companies, they're significantly larger than the third and fourth largest companies. So if we put them in at a pure market cap weight, they would be like 40% of the fund. And so to ensure that we meet the diversification rules, we limit them at 8%. And that basically takes some of the market cap away from Alibaba and Tencent and pushes it down onto the smaller companies. So it serves as almost a small cap and mid cap tilt.
Little boost. Yep.
A little boost. And that's it. And then between the rebalances, the stocks move. And, usually by the time we get to the next rebalance, Alibaba and Tencent aren't in the number 1 and 2 spots. One of the second tier companies, Mercado Libre or Pinduoduo, will have outperformed and become the largest, but then we'll sell it back down. And then we do have a fast track IPO rule. So anything that comes public that's over 10 billion in market cap is added with after 3 trading days. So we don't wait for the traditional rebalance.
And I know, previously you talked about your expertise in the area of tax harvesting and other ways of kind of augmenting kind of passive style investing. Do you do any things like that, or is it just pure market cap waiting once you've made your selection and then just rebalancing?
Well, first of all, I mean, ETFs by the nature of their structure are very tax efficient, particularly versus a traditional open-end mutual fund. So,
can you explain that to the listener who don't understand that?
well, I mean, I can put it in very simple terms. I've had it explained to me in detail several times in the last 20 years, but I don't bother holding on to those details because they're not my job. But basically, the way that ETFs grow and shrink is through market makers contributing a basket of securities into the fund of individual stocks to create new units, and the way that and also take them out to redeem shares. That structure leads to basically no capital gains taxes for the shareholders, or very minimal capital gains distribution. So this is a structural advantage of the ETF as a product category. And one of the main reasons why ETFs have caught on so much is they're very tax efficient. The traditional mutual funds have really serious tax problems, including, I don't know what the numbers look like now, but at one point, 40% of the value of the Vanguard S&P 500 fund was capital gains. And if you invested in the fund today and they sold the stock they bought 20 years ago, you would have to pay part of the taxes, even though you didn't get the gain over 20 years. So traditional mutual funds are dying a slow death, largely because the ETF structure is advantageous for investors. So it's a pretty tax efficient vehicle. And I think we actually are sitting on and carrying forward about $30 million of capital losses to the extent there are gains around the edge to offset those.
And what about reinvestment of dividends? If you receive dividends of companies that are in there, are you reinvesting those, or are you distributing them to the holders of the ETF?
They're reinvested.
Got it. Okay. Well, that's a lot of detail, and I'm particularly interested. And if for the listeners out there, I really suggest that you go and search to try to find out more about EMQQ ETF. You can just go to emqqetf.com and learn more. And I know I will be learning more. And what I call what you're doing is what I call kind of exposure fund. It's not so much that you're trying to say, I'm going to pick the one that's going to outperform, but it's like, I'm going to give you that exposure to this specific area that's not going to be that, you're not going to be sucked into have exposure to, Chinese banks that it's owned by the government and could do anything. Would you agree with that it's kind of an exposure fund, or how would you describe it?
Well, I mean, it is an exposure fund. I think that in the ETF nomenclature, they call us a thematic fund.
Thematic, got it.
But as I told you as we were getting ready for this, I made this fund for a very specific reason. I've been involved with emerging markets for 16 years and trying to find the best way to capture the real growth, which is in that consumption story. And I stumbled on what I think is, in fact, I'm quite confident, I'm not 100% sure, but I'm pretty sure that what I stumbled on is the fastest growing sector in the world ever in terms of these companies. And I offer a $100,000 reward that for anyone that can prove me wrong. I'm not 100% sure that I'm right.
Well, what about railroads?
Well, railroads were largely bound to physical limitations. These e-commerce businesses are quite scalable.
Yeah.
And so for the last 11 years, the average annual growth rate for revenue has been over 37%.
Wow.
So I've given a presentation over the last 6.5 years to hundreds of professional investor groups, 100 CFA societies around the world. I've offered a $100,000 reward to anybody that could show me a sector of publicly traded companies that ever grew for 37% for a decade. Actually, the number was 38.5 for the
Right.
10 years ended 2019. But now when I first gave my talk about this, I offered people a ham sandwich if they could show me a sector.
Your confidence has obviously grown.
Well, that was in 2014 when I first launched, and I don't have my chart here, but you can see those numbers were 40% a year plus. And then I kept giving this talk, and I decided I should make it a little more exciting. When I was in Hawaii, I offered, and actually before I got to Hawaii, I gave a CFA society somewhere, and I made it a $10,000 reward. And then I was asked to give a talk to the CFA Society of Hawaii in 2018. And maybe it was just being in Hawaii, I was so happy. I changed my reward to $100,000, but then we put a few rules in. So there has to be at least 20 companies, no cherry picking. You can't include the companies that are part of our index. So anyhow, I could be wrong, but look, it's hard for any company to grow at 30% a year for any reasonable amount of time. For an entire sector to grow at close to 40% for 11 years is, I think, unprecedented. And what's causing it is it's a mashup of three themes that are captured in EMQQ, three mega trends. The first one we talked about, billions of people in the developing world wanting stuff, right? They're the thing that's emerging, and they want all the things we take for granted. And then the second mega trend is something that we take for granted as well. And, back then when I had this idea, I was already seeing how my family's consumption was changing because of the smartphone.
Yep.
Right. I had a smartphone when I got, when I created EMQQ, but we only had it for a couple of years. And back then my family went to Target 4 times a week or 5 times a week, but I started to notice the truck was coming to my house once a week and then twice a week. And the trips to Target were going down. And so I was seeing how the smartphone was changing consumption, but I had a computer for 20 years before I had a smartphone. The reality is all these billions of people that are becoming consumers, they've never had a computer before. So the computer is the second mega trend in the story, but it's not on the desk and it never will be. So all of those billions of people are getting a $60, $80 Android-based smartphone made in China, running on Android, as I mentioned. And it's bringing with it the third mega trend, which I've had for 25 years, called the internet. I got the internet in 1995 in the Marina District of San Francisco on a telephone dial-up modem, and now the internet shows up in my pocket. Well, most of the world never got wired. And so all of these people are they're going from nothing to a computer, to the internet, and it's changing their worlds in a big way. And it's still pretty early. I mean, smartphone penetration in India is only about 2 or 3%, which means you've got 900 million people in India alone that don't have a computer or the internet. So it's those three mega trends are driving this unprecedented growth. And part of it as well is that because the consumption infrastructure in emerging markets, as you know, is underdeveloped or undeveloped. And when I say consumption infrastructure, I'm talking about bank accounts with the debit cards in everybody's pockets and televisions on the wall that have 1,000 channels coming into them, and Target stores. Because those things don't exist, the emerging market consumer is leapfrogging to more digitized consumption and bypassing the mall, bypassing the bank account, bypassing the cable television. And that, I think, is also explaining the incredible growth rate. And it's quite a paradox. You would think, the fintech part of the story, the mobile payments part of the story, is the fastest sub part of the EMQQ story. And it all starts with payments. And, as you know, in China in particular, but all over emerging markets, you can use your phone to pay for everything. And
I went to China to do my PhD, and I started in 2013, and literally, everybody used cash. And by 2016, when I finished my PhD, uh, everybody was only using their phone. Nobody carried cash.
That's exactly it. And now, I mean, I remember 2 years ago in the Nanjing subway station, I tried to buy a bottle of water at the newsstand, and I walked over to the counter and I put my water bottle on the counter, and I tried to hand the man a Chinese banknote, and he told me, no, you can't
Yep.
have that water
Yep.
with
Exactly.
with money. But up on the street, I could buy pigeons and turtles with a QR code, right? Or a lobster, like at Alibaba's grocery store. The lobster has a QR code on his wrist. So it's true.
Yep.
So it's sort of a paradox, right? You'd think a fintech entrepreneur in San Francisco like me would be on the cutting edge of this, but Africa
No way.
is on the
Africa.
cutting edge of mobile payments. More than half of the world's phone-based payments are done by people in Africa.
It's a little bit like, I remember, the big coveted prize for a telecom company in 1995, when, at the time I was coming of age in Thailand, was to win the landline contract, where you would put down the landlines. And one company got this great landline contract where they put down the landlines for all these phones, and within a couple of years, everything moved cellular, and the whole country pretty much skipped that landline, and all of a sudden that became a huge loss maker. So I can see the leapfrog. I mean, I could talk to you for a long time, but I have to say that my audience really wants to know your worst investment ever. So now it's time to share your worst investment ever. And since no one ever goes into their worst investment thinking it will be, tell us a bit about the circumstances leading up to it, and then tell us your story.
Well, so in the late 90s, I was a very confident young value investor, a Charlie Munger and Warren Buffett wannabe. And I had worked as an analyst professionally and got paid very well by hedge funds and mutual funds for my research. And this internet thing showed up, and the .com story was rolling, and I was, in addition to being young and relatively successful at that point and confident, I was also a bit naive, and I had decided that this company, Amazon.com, was really just a bookstore, and that it shouldn't be valued any way different than that. And I spent a lot of time analyzing it, and Barnes and Noble had been a pretty popular growth stock back then. They had been sort of consolidating the traditional bookstore business, and I just remember looking at it and saying, well, Barnes and Noble's got their own website, and they've got a lot more experience in this, and so I shorted Amazon.com in March of 1998 with my small net worth. I had made a decent amount of money, but then I had taken a year and a half off with my new wife and gone and traveled and spent a lot of it. And so, but I had a little bit of money left, and I shorted Amazon.com, and I lost about a third of my net worth in a day and a half. And as I think I shared with you via email, my write-up I did back then, I concluded that with a $1.4 billion market cap, that there's no way Amazon could be worth that, and that while I knew at that point that stocks could trade off of their fundamentals for an extended period of time, but I was quite confident that within a couple of years that stock would sell for a fraction of what it was selling at, and the market cap was $1.4 billion, and I think I wrote that any rational businessman would be happy to sell that company for $200 million in cash. And before I came down here to do this, I pulled up just to check the market cap of Amazon, and it's 1.6 trillion now. which I think means, I think my position, I think I shorted $50,000 of Amazon. And if I had, rather than short it, if I had bought it, if my calculator was right and I'm not missing anything, that would be worth $50 million today. So I
Tell
had
me,
that. If
what
I
have
had,
you learned from this experience?
wow, I learned a lot. And, as they say, good judgment comes from experience and experience comes from bad judgment. So, and in many ways, I should have already, I kind of knew the first lesson, which is don't make valuation shorts. I had worked as the wingman for a couple of years before this for a guy named Joe Feshbach, who was one of the sort of, kings of short selling. And he used to tell me that we don't make valuation shorts. We find fraudulent companies. And, but yet I did. I shorted something based on its valuation, based on its price.
So a valuation short for the audience basically means that you determine what you think is the value of this company. You look at the price and you say, this stock is way over the value that I calculate, and therefore I think the stock price is going to crash, and therefore I'm going to take a valuation short. Is that how you would describe it?
Oh, certainly that's a part of the way of describing it. I think it's people rightfully are focused on earnings, and they're looking at the price to earnings multiple. How much do I have to pay for $1 of earnings? And it's good to look at that, because ultimately what makes a company valuable is earnings. And so you definitely need earnings to make something have value. But what Amazon basically pioneered was, let's not even try to make earnings for a long, long time, right? Let's, rather than focus on this year, next year, the following year, and reporting earnings, let's not necessarily lose a lot of money, but let's grow and grow and grow and build a platform on which, when we choose to, we can start to make it profitable. And that is, now that's become, a bit more commonplace, right? That companies aren't getting valued based on their short-term, near-term earnings forecast, but rather on the longer-term opportunity.
So lesson number one is don't make valuation shorts. Any other lessons you learned from this?
Well, short selling has a very difficult mathematics behind it, and really, frankly, it's really just not worth it. I mean, look, the most you can make in a short is 100%, right? That's the most you can make. And by the way, if you short a stock at 100 and it goes to 0, you make 100%. And if you short it at 1 and it goes to 0, you also make 100%. So a lot of times when you short something, you don't have to pick the top. You just find it when it's on the ropes. So the mathematics are just so far against you. And the other problem is, when you're short something and you're wrong, your exposure gets bigger, right? If you're long $50,000 of Amazon and it goes down to 25%, you've lost $12,000, and your exposure is only 37 now. So it's become a smaller part of your portfolio. But if you're short something and it goes up 50%, well, now if it was 5% of your portfolio, now it's 7.5% of your portfolio. And so it's short selling as a way to make money is I think not really a good idea, especially when you can make 10, 20 times your money, or in the case of Amazon, 1,000 times your money, if you're long and take advantage of the miracle of compounding.
Yep. So maybe I'll summarize a couple of things I take away. I mean, the first thing is we have to always remember, and part of this podcast, we go back and we look at mistakes that people make, and we are engaging in hindsight bias. In other words, we're looking back and saying, if only I had done this. But, when we are making these decisions, we're making them with the best information we have at the time, and then our application of our judgment at the time. So first thing for the audience to remember that as we think back. The second thing is, I would say, what I think a lot about is kind of the overconfidence bias. I know as an analyst, I've valued, many companies over the years, and I've taught valuation now for 30 years. And what I can just say is that I always tell my students, you are always wrong. It's just a matter of degree. Nobody can make a perfect valuation. And so the answer to that really is questioning everything. And even you may not have the capacity to ask the right questions, such as if you think back, Kevin, to when, you were going through this, you wouldn't have had the capacity to be able to think the earnings of this company could explode by, this could go from $1 in earnings to 1,000. No, nobody would have that capacity to go to that length. So in that sense, this is where hindsight bias is really dangerous, because we're looking at an anomaly, right? But the point I would just make is, in valuation, we come up with a valuation estimate, we look at a range of value, and we have to accept the fact that it is an estimate. That's kind of my biggest takeaway. Anything you would add to that?
No, I mean, I think well, I mean, look, it's the irony in the fact that as you mentioned, that the same week that I was shorting Amazon, I also saw this company change its name from KTEL to KTEL.com, and I found my copy of Random Walk, and I picked up the phone and called the author, who ended up becoming my business partner. And he drug me into China, and now I have a China focus. That's all emerging markets, but a China internet company, or a fund that invests in Chinese internet companies, the Amazon.com of China. So the irony in that I went from there to here is not lost on me. And I kind of gets to what you said, is like the world is changing, and it's always been changing, and it's always going to change, and it's hard to make forecasts about the future. And but one thing is for sure, and that is the miracle of compounding. And the worst investment, many of my other worst investment decisions were selling things that I purchased that were absolutely the right things to buy, and I was happy to take 100% or 200% gain in them, when if I had held them, I would have had, in some of these 20, 30, 40 baggers, but just by letting that calendar flip over and the miracle of compounding work, in my favor.
So let me ask you, based upon what you learned from this story and what you continue to learn, what one action would you recommend our listeners take to avoid suffering the same fate? And part of what I want you to address in that is that time, going back in that time when you had the confidence of, I think I've got this right, I'm ready to bet some serious money on it.
Well, I mean, all that really matters to me, and I think to any investor, is the PEG ratio, right? It's the PE versus the growth rate. And this is, this is Peter Lynch stuff 101, and it's not far off of John Burr Williams' theory of investment value. But the math of investing is pretty simple, right? You've got you're competing against the bench, the index called the S&P 500, and you can see what its PE is and its growth rate. So you can see what its PEG ratio is. And then you've got, any other index you want to compare yourself with, if you're emerging markets, for example. And then you've got the risk-free rate. And so, anytime you can find a PEG ratio lower than the S&P, and hopefully with a better business than an average business, then that's what you want. You want great businesses at reasonable prices, and it really all comes down to the PEG ratio. And I'm still surprised a lot of times that not every investor seems to understand that.
Can I ask a question? So for a new investor, they may look back, or for any investor, they may look back and say, well, Kevin, when you were looking at Amazon, you estimated the the growth, and the PEG ratio, and let's just say that let's just say it had earnings or something like that, and you say, PEG ratios next year's, and let's say the growth next year is 20%. But the question I have for you is, when you talk about the PEG ratio, we're talking about PE relative to earnings growth. Earnings growth over what time? Because if you had been able to accurately predict Amazon, you would have said 1,000% average annual return in earnings growth over the next 10 years, but not over the next 2.
Okay, well, you've just caught me, I guess, in not being consistent in what I'm saying. So, first of all, when I look at the PEG ratio, I use the revenue growth rate. I don't use the earnings growth.
Great.
I mean, obviously, earnings growth is what you're there for, but to me, the purest measure of a company's growth is revenue, right?
Particularly in the area that you're looking at, where it's internet, e-commerce, that type of stuff. Yep.
That's right. And so
and over what period of time are you thinking when you're kind of
always long term, 5 years? And so what I look at is the PE divided by the revenue growth. Now, but as you're pointing out, well, sometimes there is no E, and so
that problem's eliminated if you use revenue.
Well, that the G stays, but there's no E in the PE, so you can say, well, let's say Amazon's selling for 1,000 times earnings, and it's growing at 50%. You can say, well, that's a PEG ratio of 200.
Yep.
Right. And so I'm thinking of the group that I invest in collectively.
Yep.
When I look at that group, while I know we have some companies that aren't in earnings mode, right? They're in land grab mode. We Windsorize those numbers in producing the PEG ratio. So the sort of core PEG ratio for the group I invest in right now is 0.8.
Yep.
So you've got 30 this year, 38% revenue growth and a PE of 30. So it's got half the PEG of the FANG stocks and a third the PEG of the S&P 500. But you're right. I'll have to rethink how I say that, because we definitely invest in things that don't have any E at all right now.
Well, I think it's a good takeaway, the idea of using revenue growth, number one. Also, for the audience out there, he talked about the idea of Windsorizing. And if you were to rank every stock that you're looking at, let's say 100 stocks, and you put them into deciles, you would see that the top decile, the fastest growth, and the bottom decile is the slowest growth. But 1 out of those 10 could be massive growth or massive negative growth, and it would distort the numbers. So Windsorizing is just taking the average of that top decile and applying that to that most extreme point to try to take it out of that. So last question, what's your number one goal for the next 12 months?
My goal is pretty simple. Have fun. I'm going to Mexico 2 of the next 3 weeks. So I'm going to say my main goal is to have fun and try to re-enter the real world, which, as we talked about, it's a little stressful. So, the stress disorder of being traumatized by the lockdown is probably worse than the stress of re-entering the world. But I'm going to do my best to overcome that.
Exciting.
As I sit on the beach.
Sounds great. And one last thing I would say is that this discussion reminded me of one of my favorite quotes from Yogi Berra, and I just looked it up to make sure I got it correct. It says, "It's tough to make predictions, especially about the future." So listeners, there you have it, another story of loss to keep you winning. My number one goal for the next 12 months is to help you, my listeners, reduce risk and increase return in your life. To achieve this, I've created our community at myworstinvestmentever.com, and I look forward to seeing you there. As we conclude, Kevin, I want to thank you again for coming on the show. And on behalf of A Stotts Academy, I hereby award you alumni status for turning your worst investment ever into your best teaching moment. Do you have any parting words for the audience?
No, have fun, enjoy the rest of the year, and let's go 2021.
Amen. And that's a wrap on another great story to help us create, grow, and protect our well fellow risk takers. This is your worst podcast host, Andrew Stott, saying, I'll see you on the upside.